A discussion of central bank operations and interest rate policy by Warren Mosler and Phil Armstrong. Setting the policy rate with a corridor system. Numerous central banks have utilized the so-called corridor system to establish their policy rate of interest. The standard model of the corridor system, as described by the Bank of England, 2010, establishes an upper boundary called a ceiling and a lower boundary called a floor, thereby ensuring that the policy rate of interest will be between the two limits. The model assumes profit-maximizing banks, from which the expected shape of an individual bank's demand for reserves can be derived, and, by implication, the demand curve for reserves as a whole. The bold red line in this standard model, Figure 1, shows the demand curve for bank reserves in the interbank market. It is horizontal at the lending rate, on the assumption that profit-maximizing banks will not borrow from each other at a rate that is higher than the rate charged by the central bank. The downward sloping section reflects a particular conceptualization of bank behavior, specifically the view that banks respond to a fall in the interest rate or fall opportunity cost of holding reserves rather than lending them to other banks by increasing their demand for reserves. Footnote 1. The higher the market rate of interest, the higher is the opportunity cost of holding reserves, and hence the lower will be the demand. As rates fall, the opportunity costs fall and the demand for reserves increases. But in all cases, banks will only seek to hold, in aggregate, the levels consistent with their requirements. Mitchell, 2010. End footnote. The final horizontal section reflects the fact that banks will not lend reserves to each other below the rate they can earn from the central bank. It is then theorized that, given the shape of the demand curve, the central bank can adjust the aggregate amount of reserves, S, used in open market operations, and thus hit its target rate. The lending rate is the rate at which banks can borrow reserves from the central bank, discount window, and the deposit rate is the rate paid on reserves deposited at the central bank, referred to as standing facilities by the Bank of England, 2010. The policy rate lies between the deposit rate and the lending rate, and these the two administered rates define a ceiling and floor for the overnight rate, and limit the potential divergence of the overnight rate from the policy rate. Internationally, variation exists in the exact implementation of corridor systems, but the principle behind the policy remains the same. The central bank uses open market operations to adjust the level of reserves in the system, enabling it to hit its policy rate. The system relies on an orderly functioning interbank market, which in turn facilitates an efficient distribution of reserves between banks. While we agree with the functioning of the corridor model, our narrative differs from the standard account. First, we see the demand for reserves as being fixed at any given point in time, and as functioning of something other than interest rates. This view is described by the blue line below. Second, we disagree with the standard model narrative, which states that the central bank controls rates and achieves its policy rate by altering the quantity of reserves. And instead, we argue that close inspection reveals that interest rate policy remains best understood as a matter of setting rates and not quantities. For example, if there is a shortage of reserves in the banking system, for any individual bank that shortage is accounted for as an overdraft loan, discount window loan, from the central bank. That is, in the first instance, a bank's shortfall in its central bank reserve account is accounted for as a loan from the central bank. And if the central bank sets the rate for these loans at the policy rate, there is no need for the further action, such as adding reserves via repurchase agreements or outright purchases of Treasury securities, suggested in the standard model. It is only when the central bank adds what is called a penalty rate to this type of borrowing, or if a stigma is associated with loans from the central bank, that banks then attempt to borrow in the interbank market in order to replace higher-priced loans from the central bank with lower-priced loans from other banks. Footnote 2. It may be that discount window borrowing might give the impression of financial weakness, and so would be avoided if possible. See below. End footnote. As a point of logic, the bank would be willing to pay more than the policy rate, but less than the discount rate plus the amount by which it values any stigma. In the U.S. case, for example, when the Fed observes the Fed funds rate trading higher than its policy rate target, it then takes action to make reserves available at a lower price to bring the Fed funds rate down to its policy rate. In the case of an reserve excess, the central bank can simply pay interest on reserves, which again is about setting the interest rate rather than the quantity of reserves. Alternatively, the central bank can offer securities for sale, which support rates as determined by the interest rate, which is implicit in the terms offered by the securities being sold. Footnote 3. In practice, lag accounting and reserve averaging regulations work to both destabilize and to stabilize interbank rates, a consideration of which is beyond the scope of this article. See Mosler, 2012. End footnote.